Hello and welcome to the post-budget Fit Finance sessions. Way! What an exciting budget statement it was yesterday from my man Rishi, and I'm here today with Tim and Tom to dissect it in all its glory and bring you the startling highlights of yesterday's budget. So without further ado, I don't know how you guys want to do this, but perhaps Tim, you want to give us your particular highlights of yesterday's budget.
Yeah, sure. But I think, generally speaking, I think there was a lot of pent up thought pre this particular budget, of course, wasn't there, with all the spending and borrowing, particularly that's been going on. So I think there was a lot of expectation there, whereas actually it was a bit of a under-deliverance, really. I think it's obviously I'm not going to reel off all the changes or amendments, but I think 90 billion is the expected raise over 5 years, whereas of course, what was it, 465 billion total borrowing. So clearly that's only a drop in the ocean, really, as it were, over the long term. So I think it's going to be it's a first step of many, I think, that's good, of changes that are, going to be over the next couple of decades, that, we're all going to be in this hole of paying back what's gone on over the last 18 months. But one of the main ones for me was the extension of furlough to September, and stamp duty, because that's been a predecessor to lockdown. So I'm keeping everything crossed. That doesn't mean that I know that obviously there's been a roadmap set out, but hopefully that doesn't turn back around and we end up in the same situation all the way through for pretty much the rest of the year.
Are you out looking at houses then, Tim, to take advantage of this stamp duty holiday?
Just as much as anybody is on Rightmove, I guess, but no, I'm not kicking about in the car.
I think you're right. I mean, one might argue that the furlough extension could have been better signposted, and I know that's been a gripe from some, but it certainly seems for, I imagine, the hospitality industry, who are going to start coming back online through the beginning of April, but probably they should be mainly up and running by the summer, that there's some relief there to help those industries. And the last thing they want is for big unemployment, because with big unemployment comes the cost of paying benefits and the lack of income tax that they get from employees. So I suppose you want to keep those jobs going for as long as you can.
For sure.
Tom, what was your thoughts around it?
Yeah, I think it just, I feel like I'm a broken record, but it's just more stimulus, isn't it? It's, there's no point, like you said, having more unemployment, because that's taking money out of the system. If those people don't have jobs, they can't go spend it in bars and restaurants and other bits. And it's a self-fulfilling prophecy. More money sloshing around is more economic output and less people kind of not contributing to output. I think the main thing is the corporation tax rises, isn't it? It's we've had a good corporation tax rate for a while. I think it's still the lowest in the G7, even with these new rules, and I think it matches what's going on in the States. And you know what, companies have had the support, and now they're going to have to pay a little bit towards it. But again, they don't want to take too much away in the short term, because you'll cut the recovery off at the knees. So it's interesting about the 130% investment rule. I think everyone will be out buying tractors if that's the case. So we've got to find out what qualifies for investment, but that could be an interesting piece of planning going forward.
They certainly will up in Rutlandshire be buying tractors, that is. I don't know if any more of the less rural communities will be up for that. I think you're absolutely right. I mean, that's straight out of, we don't want companies to hold money in their bank accounts. We want them to go out and spend it. And I guess that drives inflation. I mean, I don't know how much inflation it'll drive, but it'll certainly drive some. I mean, inflation's probably going to be quite useful right now to erode some of this debt.
Yeah, and I think, you know what, if you're incentivizing people to expand, and they'll cause wage demand, and hopefully, I know if companies are getting money effectively to invest and take employees on, that'll keep unemployment low, that'll push wages higher, or should do. No one knows exactly what's going to happen, but I think if you're thinking long term, you've got to be preparing for more inflation. I think that alarm bell is ringing across everything that's going on. It could be wrong, but I think that's the key thing. But all the other tax bits and pieces have either stayed the same or frozen, or pretty much business as usual there.
Well, that's right. Go on, Tim, run us through the personal tax consequences of Rishi's budget, or those that you can remember.
I was going to say, yeah, crikey, okay. Well, as Tom alluded to, there's a lot of freezing going on, so the personal allowance thing has been frozen at 12,570 per tax year from 12,500, so a couple of digits more there, or one digit difference. The basic rate tax band, I believe, is going up ever so slightly, but higher rates is going up slightly as well, but being frozen essentially. So there's a lot of freezing, whereas normally you'd see it increase incrementally each year. Lifetime allowance staying as it is. So there's been a lot of, pensions are always on the horizon of every budget, aren't they? And everybody always expects a landslide change. Broadly speaking, because there hasn't been a massive change since 2015 and all those flexibility rules came in. But that's pretty much the same. CGT, same again. Any listeners that recall our podcast projecting sorts of weird and wonderful changes to CGT, obviously that's been blown out of the water. So as Tom said, yeah, a lot of them on the personal taxation front, it's sort of business as usual, not a lot of crazy differences. But it is interesting though, isn't it? Particularly so soon after Brexit, that the sort of the primary change is on businesses, albeit the primary change being those that profit more than 250k per year. So still favourable for those smaller, arguably younger businesses at least. But yeah, it is interesting, don't you guys think, that post-Brexit, perhaps there should be some more encouragement, or you would have thought there would be some encouragement for the business side of things, but then actually something to make it far less attractive for new investment at least.
It's interesting because there was some support for business, wasn't there? Obviously, the corporation tax, the businesses earning over $250,000 in profits, less so, but there was some in terms of R&D allowances, although he didn't really elucidate perhaps in huge detail the research and development allowances that were coming through, and EMI shareholdings and stuff like that to encourage new startup tech companies, I guess, to try and go toe to toe with California or some of those other emerging areas, and opening up visa reforms onto a points-based system to encourage immigration into the country to help drive those sort of industries. But you're right, for companies that are already up and running in the UK, I guess there wasn't so much support. Free ports as well. What's a free port?
Yeah, I think if you look at the American market, they pay, say, less dividends, they reinvest in the companies, they go for growth, and whereas historically, I know, look at the FTSE 250, they'll pay dividends, they're a bit more of a slave to the pension funds that are invested in them, and I think there's a want to maybe push more to make companies reinvest and grow, rather than just do the same. And I think the States has actually got a better mentality there, so hopefully some of that encourages it. And I think all the R&D stuff, I think that's a legacy of perhaps the sort of Dominic Cummings area, where they're trying to promote. It's something the UK is really good at, so why not try and work to our strengths? So hopefully, yeah. Come to a free port near you soon.
Yeah, I mean, certainly, I think one of the interesting things from a personal financial taxation planning view is going to be for those business owners who are on, or whose company's profits are on or close to those thresholds. So then there's still going to be 19% for smaller businesses, and if you're earning just over £50,000 of profit, there's going to be a huge temptation to either pay yourself a little bit more to bring the company profit down, or to put a bit more into a pension. And the same, although it wasn't detailed, the way that it's going to taper up to $250,000. So for those company directors in those positions near the taper, it'd be interesting to see what planning they can do to keep their corporation tax rates down, I guess. Oh, we'll see. Anything else that you guys wanted to bring up about the budget? The one other thing that I thought was quite interesting, and again I don't think it's going to be announced until the summer. At the moment, as everybody knows, it's impossible to collect interest rates from anywhere, whether or not it be the banks or even national savings and investments. I think premium bonds are the most generous savings account that I'm regularly advising my clients utilize, but even that's only 1%, and that is probably a bit less than that if you take away the £1 million prizes it gives out every year. But they are thinking of they've announced that they're going to bring out a green bond through NSNI, which will be interesting. We don't know how much interest it's going to pay, but certainly I imagine that if it's paying more than 0.01%, which is what their income bond is currently paying, there might be some take up from some of my clients on that. What about you guys? Do you think your clients will be interested?
Yeah, I think so. Both from, I don't know, cash is all pretty much the same. There isn't much difference between any of them. So yeah, you might as well buy the lottery tickets via premium bonds. But I think if you are going to sit with cash, you might as well put it into some sort of green structure. And I think countries like the Netherlands have got similar structures, and you'll get information about where that money's been spent and invested. So it'll say X amount of the fund has been used to, I don't know, produce better public transport and things like that. So yeah, I think if you're not going to earn anything, might as well put that money to I don't know, a better worldwide use.
Yeah, I think similarly. Yeah, I mean, yeah, as Tom says, there's not really much difference between most of the accounts, to be honest. But generally speaking, I'm seeing far more interest in those more types of investments, particularly with that kind of attitude towards money and using their money, investments or cash, in whatever way that they can to make the world a better place, or to do these sorts of investments. So I think there's another avenue in which they can do that. I think there'll be an increase in interest there.
Yeah, cool. Me too. Interesting. Well, no doubt we'll bring news of the green NSNI bonds to you in a future FFS podcast. So keep tuned for that very exciting news as and when it comes. I think that's it for now. Thanks very much for joining us. Next week, no doubt there'll be more fallout from the budget that we'll bring to you. But if you've got any questions, then do feel free to get in touch. But until then, goodbye.